Hello YouTube, Herman Williams with ATM Financial Services, bringing you another Money Smarts lesson on personal finance. Today we're going to continue with our series on retirement planning. Now in previous lessons we briefly touched on diversification when it comes to your retirement portfolio. We've also mentioned something called market cap. Today I want to elaborate on both of those topics and talk more about how you can or should structure your portfolio. Let's start with understanding what market cap means. Market cap or market capitalization is a term used to describe the market value of a company expressed in a dollar amount. Since it represents the market value of a company, it is calculated by using the current market price of one share of the company's stock and the total number of outstanding shares. Now, outstanding shares simply means the current total number of shares held by all shareholders of a company. You should also understand that the number of shares outstanding for a company is not a static number and it can fluctuate over time. Companies sometimes issue more shares for sale if they need to raise capital, and sometimes companies buy back some of their shares for a variety of reasons. So to compute market cap, you simply take the current number of shares outstanding and multiply it by the current market price per share. For instance, if a company has 10 million shares outstanding and the stock is currently trading at $50 per share, the company has a market cap of $500 million. While this may sound like a lot of money, and it is, but as we go through this lesson, let's see where it falls out in terms of market cap. Now, market cap is a financial term that's used to indicate the size of a company. So let's look at different categories or sizes of companies, and starting at the top, we have what is known as mega cap. This category includes companies that have a market cap of $200 billion or higher. Mega cap companies are the largest publicly traded companies by market value, and they typically represent the leaders of a particular industry sector or market. A few examples of mega cap companies are Apple, Amazon, Alphabet, which is the parent company of Google, Verizon, Home Depot, Visa, just to name a few. There are a limited number of mega cap companies, and the threshold for being a mega cap sometimes changes with market conditions. Next is large cap. Companies that fall into this category have a market cap of between 10 billion and 200 billion. Sometimes the term large cap and mega cap are used interchangeably, so you may see companies listed on both lists. For purposes of this lesson, I will mostly refer to mega cap and large cap as one and the same. Now let's look at some of the pros and cons of these largest companies so you can better understand how they might fit into your portfolio. Now on the plus side, these are mostly stable companies that have been around for a while and have established themselves as market leaders. They typically are financially sound and usually have a track record of consistent growth and profitability. A lot of these companies, but not all, also pay a dividend to shareholders. A dividend is a portion of the company's profit, and it can be paid monthly, quarterly, biannually, or even yearly. Dividends can typically be received in the form of a check, or they can be reinvested and used to buy more of the company's stock. Just be aware that if you receive a dividend check, there could be tax implications. Now, as you are growing your retirement portfolio during your working years, you are usually better off reinvesting those dividends. During retirement, dividends can provide a nice income stream. Another plus for large or mega cap companies is that they usually have a reputable management team. You don't become that large without good management. Another thing that makes these companies attractive to investors is that they are generally viewed as being safer investments compared to mid-cap or small-cap companies, which we will get into in a moment. Depending on the cause of market volatility, these companies can also sometimes have an edge on smaller companies when it comes to riding out fluctuations in the market or even larger shifts in the economy. And because these companies have typically been around for a while, there is usually more data and more transparency. For this reason, larger companies can also be easier for investors to evaluate. Now let's talk about some of the cons of these larger companies. First, these types of stocks are generally not well suited for the investor who's looking for a quick buy and sell win. These are long-term investments and better suited for a buy and hold strategy. This also relates to another con, which involves the return profile of large cap stocks. Generally speaking, the more risk associated with a stock, the higher the potential return. Since large cap stocks are seen as less risky, you may not see the sky-high returns you might get with stocks with a smaller market cap. Some large companies may have grown rapidly for a while, but now that growth may have slowed considerably. Now let's move on to mid-cap stocks. These stocks range in market value from $2 billion to $10 billion of market cap. This group of companies is considered to be more volatile, meaning their stock price may fluctuate more than large cap and mega cap companies. Stocks that are considered growth stocks make up a significant portion of the mid-cap stocks. Growth stocks are the stocks of companies who may not yet be industry leaders, but they may be on their way to becoming leaders. Some of the pros to mid-caps are higher returns compared to larger caps, less risky than small caps. They're good for long-term investing, and they offer lots of investment choices and a good way to diversify economically, meaning you can find companies that represent a variety of industries and sectors at a lower stock price than the larger cap companies. Some of the cons to this group include higher volatility compared to large caps, less upside potential compared to small caps, in some cases less data than large caps, which could make them harder to evaluate, and also not the best choice for short-term investments, meaning 1 to 3 years, due to the fact that their growth could be sporadic at times, and they may not be as well positioned to withstand market fluctuations or large economic fluctuations. Lastly, we have small cap. Small cap companies have a market cap of between $300 million and $2 billion. The bulk of this category is made up of relatively young companies that may have promising growth potential. However, a few older established businesses may have lost some of their value for a variety of reasons, and they may also find themselves in this category as well. While small cap stocks usually don't have as long a track record as mid cap or large cap, which can make them harder to evaluate, they can offer huge upside potential. So which category did our example company with a market cap of $500 million fall into? It sounded like a lot of money when we first said it, but as you can see, it actually falls into the small cap category. As you think about building or diversifying your portfolio, please don't make the mistake of equating stock price to value. There are many large cap stocks that carry a high price, but may not be a good value or may not be a good value for you. There have been many stocks which have seen their stock price run up into the hundreds of dollars before they ever even turn a profit. By the same token, a low stock price does not necessarily indicate a bargain either. There are many things to consider when you are evaluating stocks. Market cap is one of the better ways to begin evaluating a stock, but it is certainly not the only thing to consider. The bottom line is size does matter, and understanding the concept of market cap is an important part of developing your investment strategy. By understanding your own individual risk tolerance and understanding the type of return you are seeking, you can decide on the right mixture of small, mid, and large cap stocks to add to your portfolio. This is just a stock portion of your portfolio. We still need to consider bonds, which we will cover in another lesson, cash, and international or global investments as well. A well-diversified portfolio should include all of these things. Getting the right proportions of each is specific to you, your risk tolerance, your time horizon, your required rate of return, and your resources. A carefully constructed portfolio should take all of these things and more into consideration. If you need an advisor to help you craft your plan, please reach out to me through my website and I will be happy to assist you. Another option to consider is to choose what is known as a portfolio model. You can choose an option from very conservative to very aggressive, and the model will choose the percentages of each category accordingly. While this may be a good way to get started if you are new to investing, just be aware that the model you choose may or may not meet your retirement objectives. A plan that is tailored specifically to you is the best option. This lesson is intended to help you understand some of your investment choices and the pros and cons of each. I hope I have succeeded in giving you some knowledge that will help you in your decision making. Please leave your comments and suggestions on how I can make these lessons better, or if you have specific topics that you would like discussed, please leave those in the comments box as well. And don't forget to hit that subscribe button if you haven't done so already. And until next time, behave well.